Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now we're following in the BNN Bloomberg newsroom. Well, the federal government has unveiled its new AI strategy to boost adoption, commercialization, and sovereign computing capacity. Ottawa will provide funding to help AI companies scale up and plans to take equity stakes in Canada's most promising AI firms. The new strategy also aims to have 60% of Canadian businesses using AI tools by 2034. Ottawa says it will also strengthen privacy laws and safeguard consumers against surveillance pricing. Shares of Canaccord Genuity are surging today, up more than 5.5%. This after the company posted higher than expected fourth quarter revenue, with that metric jumping 33% compared to the same period the year before. Profit also came in above expectations. Canaccord says the results were driven by higher investment banking, while wealth management continued to scale. Shares of Transcontinental are trading lower after profit fell in its most recent quarter. Lower revenue and higher financial expenses also impacted the period. The Montreal-based company also anticipates lower returns in its book printing sector for the remainder of 26, but says the closing of its packaging business will allow it to focus on its growth strategy. And a quick look at the markets, and you can see the TSX on a nice little run today, pushing back well above 35,000. Not quite record high, but getting close again. It's up by 1.2%. Pretty much all the indices are in the green, save for communications. And south of the border, slowly, the NASDAQ is coming back. Had a rough start to the morning. On Broadcom's earnings, that was driving things down. It looks like it's bouncing back, not quite into the green, but off by about 0.12, but above 26,800. And the S&P 500 up nicely, 0.39%. Yeah, and we are watching Broadcom today. Look at the numbers right now. It's off by nearly 14%. Sales forecast fell below estimates. Here to discuss the AI market and more is Liz Miller, president and founder of Summit Place Financial Advisors. Liz, thanks as always for joining us.
Hello, thank you.
Just quick thoughts on Broadcom, and is that an indicator? Should we be worried?
We always should be worried. We know we're in a very fast-growing arc with AI. The demand is so explosive, and none of us know where it starts. So this move today from Broadcom, though, is more a reflection of just how tightly wound this market is around it. Earnings came in pretty much as estimated, a little bit up. Software a little weak, but what we're really seeing is that when those expectations are so high and priced to perfection, there just isn't any room for even a trip. And this wasn't a trip. This was that management gave a forecast for forward quarter revenue, and they didn't move it up. They kept it flat, and a lot of analysts had ratcheted up a little bit. Was that management being conservative or management having some insight? We won't know for another quarter, but this is how the market is responding today to these very, very high expectations. And let's be clear, the valuations reflect those expectations. So if companies can't sustain them, then it does make sense that valuations are going to be coming in a bit.
And so with that, though, we should take this, I guess, as you said, we have to wait for the quarter, always the magic numbers. But overall, for the AI market, it still looks promising and strong?
It does still look strong. I mean, Broadcom had tremendous numbers, and even its unchanged estimates are for tremendous growth, for its specialized chips. And when you really look at the stock action today, the stock has pulled back to where it was about 2 weeks ago. What really happened was the stock shot up in anticipation of being blown away by these earnings. And instead, Broadcom just met the expectation. And so the stock has not pulled back to a level that suggests it's turning down. It's really just pulled back where it was very, very recently, days ago, a week ago at most.
All right, so really, it's just things are just settling down and looking realistic, I guess, might be the way. Taking a look at energy, where are we now with the AI build-out phase of development when it comes to energy, do you think?
I think the energy part of AI is something that really, in some ways, is getting forgotten in our Mideast conflicts. We are focused on rising energy costs right now, constrained supply, and we're seeing it come through at the pumps and inflation very clearly. And the focus seems to be on when can we reach agreement to end this conflict in the Middle East. And not to say that's not significant, it is, but I think it's overshadowing that we have another longer term constraint on energy supplies, and that's the huge build out of data centers. We see anecdotally all over the place the demand for energy for each of these, and we really haven't worked that into the underlying energy demand numbers yet.
Is the demand that great? Is it possible we might not be able to see it met?
I think there's a really true concern in parts of the country it may not be met. Now, we know that companies are trying to locate these data centers, where they can get acceptance to build them, but where the workforce and the energy supplies are there. But at a certain point, there's a very real concern that we will be energy constrained in this country because we've had pretty stable growth for many years. And this is, a huge, if it may be double digit, it's certainly single digit ratchet up to the annual growth demand of energy in our country.
And with what's going on in Iran, how much of a factor would that be with that potential energy pressure?
Well, I think it's a big factor because we know that even if a deal is reached very soon, we're going to see the effects of higher energy prices come through the economy really for the next couple quarters. So far, we're seeing it mostly at the pumps. When we start getting Q2 earnings in July, I think we're going to start hearing about how businesses have been impacted by higher costs and how much of those costs they've had to push through to consumers. Even if the Strait of Hormuz gets opened immediately, we know there's a long backlog. So we're still looking at a minimum, probably several quarters to a year of constraints in the United States and then resulting likely higher prices for many goods and services.
All right, I want to get a look at a couple of stocks you have your eye on. Elf Beauty Supplies, what's the draw there?
Sure. Well, we're looking at a market, where we know the S&P 500 and the NASDAQ 100 are being driven by the AI trade, by the mega cap companies that are super benefiting. But below the surface, there's a number of companies where the stocks have really been decimated, mostly in the consumer discretionary area. And these are pretty good companies that have some attractive growth going forward. Elf really is on trend for teenagers these days who really buy multiple makeup and skincare goods, more than just what they need. It's a collectible almost in their daily wardrobe. And as that trend grows, we've got some good demand coming to low-cost products that Elf provides. And they have a lot of leverage yet with their Rhode brand that we expect to see. You can see the stock is much less expensive, has appreciation going forward, and pretty good growth at these very low prices.
All right. And the other one, Toast the most?
Yeah, Toast is a POS system really for restaurants and delivery. Similar stock picture, really a stock that has been trounced at, quite a low, trading at a PE it hasn't seen in a decade. And again, double-digit growth expectations for the next couple of years, but really in this area of the economy where there's a lot of uncertainty and where there's been struggles recently. So again, we think it's a great time to get into a stock like this for appreciation over the next few years, and you get to get it in a pretty attractive price today.
All right, we have to wrap it up there, but Liz, thanks as always for joining us.
Thank you.
Liz Miller, president and founder of Summit Place Financial Advisors. Well, shares of Canaccord Genuity are trading higher today. That's after the company posted higher than expected fourth quarter revenue. Stay tuned for a chat with the CEO after the break. Canaccord Genuity, a Canadian investment banking firm with operations in 10 countries, beat analysts' estimates in its fourth quarter, with revenue up just over 30% year over year. We got more from the CEO of Canaccord Genuity.
It was a good quarter right across the board. Obviously, we've invested an immense amount of resources in our wealth business. Our wealth business continues to grow substantially, almost $150 billion in assets in that business, and Canada's been a great driver of that. But it's also, we've had a pretty constructive capital markets business here for the last little while. We're seeing a return to risk in the market. You were talking about that with your previous guest. There's, more money being deployed in the capital markets, and we're seeing some entrepreneurial companies now start to raise money, particularly in Canada and Australia. So that was very helpful too to our quarter.
I did want to talk about Canada and Australia, actually, those wealth platforms. How do you assess the outlook in terms of margin expansion and competitive positioning moving forward for Canada and Australia in particular?
Great. Both of those markets are phenomenal markets for us. In Canada, we are the dominant non-bank wealth platform in this country. We call it independent platform. And this is a business that started, we started growing it 10 years ago. It was $8 billion in assets. It's almost $60 billion. It's $55 billion in assets now. So it's increased materially. And we represent a great platform for the people who don't want to work at the banks to work at. We've got a full service offering here. We've got a great reputation and a great platform for people to come over and work for us. So that's worked out very well. And we also give them the tools, so they've been able to grow that business substantially. So, we've had an immense amount of success. It's a very, very profitable business. We're replicating that success that we've had in Canada and Australia. In Australia, 5 years ago, we had a $1 billion business. Today, that's an $18 billion business. We made 2 acquisitions in that business, including one, Wilson's Advisory, which we just closed, and it's worked out very well. So now we've got a profitable, growing business in Australia, and it's the same dynamics there. If you're looking for an independent platform that can give you all the tools you need, we're attracting new advisors to that platform. We've got offices right across the country, a big national footprint in Australia, and we see significant growth in that market as well. What
are some of the headwinds, though, particularly for your Canadian and Australian market? Would it be raising interest rates?
From the wealth side of our business, there's no particular headwinds. Rising interest rates is interesting, but and it could ultimately hurt the market a little bit. But these are a lot of this is discretionary portfolios or managed portfolios. They'll switch their investments from things that are more interest rate sensitive to less interest rate sensitive. So those aren't going to be particular headwinds. I don't want to say we don't see headwinds, because there's headwinds in all businesses. But as long as people continue to deploy money in the capital, in the market, there's no headwinds. That business is growing substantially. Our average advisory team in Canada now is almost $400 million. It's a 30% increase. There's no natural headwinds in the business. We just got to stay out of our own way and let our entrepreneurial advisors do what they can do.
What about for capital markets, though? Because I heard you say on the earnings call the capital markets is tough to predict compared to your wealth management side of the business. Can you elaborate?
Question, and you're absolutely right. There is potential headwinds in any capital markets business, and that really is a function. The sectors we serve are the entrepreneurial sectors. Whether it's the early stage mining companies or technology companies or sustainability companies, it's the companies that drive the economy. And obviously, when the economy is a little bit more circumspect, though the capital being deployed towards those sectors goes up and down. So those are more volatile and they're harder to predict. We've been very successful in doing it. We continue to see good success in the next couple of quarters, but we just can't sit here. And if you heard the earnings call, you're right. We just can't sit here and project that 6 months in advance. It's a tougher thing to do. So you're right from that perspective.
When it comes to any recent pressure on private credit, though, how does that influence the way Canaccord advises clients?
Yeah, no, that's another great question, Lindsay. Private credit, what that drives mainly is M&A, right? When you buy something, you got to pay for it. You either pay for it with your stock or you pay for it with debt. And a lot of that debt, if you're not a bank client, if you're a more risky client than the banks would otherwise do business with, which are more or less many of our entrepreneurial clients, they need to get the credit from somewhere, and they get the credit from private credit. As that market backs up, it could slow down M&A. We're not seeing that right now. Maybe on the tangent we are seeing it, but that's where that business would be impacted, and our M&A business, which had a significant increase. I mean, in Canada, that business was up almost 300% year over year. So that could impact that business going forward. We don't see it right now, but obviously that could be something that happens.
Yeah, and you did say as well in your earnings call that your M&A pipeline continues to be really strong. I know you said you closed Wilson's Advisory, but do you have any other any acquisitions or mergers coming up this year or the next year?
Always looking at things, but from our perspective, it's a cultural thing as much as anything else. So, there's things that could make sense on paper that don't make sense, over a dinner, if you know what I mean. So, we've got employees are by far our most important asset in our business. We own a significant chunk of our public company, 46%. We continue to increase the ownership in our company. So if we're bringing on a new firm, it's got to fit culturally in our business, and I think that's the biggest criteria.
I want to bring AI into this, of course. Where does Canaccord see the most AI-driven investment opportunities moving forward?
If you look at AI, if you search in Claude or you search in 365 or a Copilot, and you say, what's the business that can most benefit from AI? One of the top 3 businesses they'll say is wealth management. And so if you just ask AI the question, that's what you get back. And we see that. We see AI as a significant tool in our wealth management business, making it more efficient, making the advice you give clients better, and be able to service more clients with a fixed number of people. So we're deploying a lot of resources around AI. It's a significant effort in our business. There's licenses right across the business, but it's still cutting edge, and how exactly it gets used inside the business is changing. Mainly it's going towards our back office functions and towards our wealth management functions, but we're increasingly using it in investment banking as well. It's an important tool that helps us advise clients.
Lindsay was speaking with Dan Davio, CEO of Canaccord Genuity. Coming up, Ottawa unveiling its AI strategy, explaining how it will help the country adopt artificial intelligence and support domestic AI companies. We'll speak with an executive from one of Canada's most prominent AI firms, Cohere, when we come back. Ottawa unveiling its AI strategy this morning, explaining how it will help the country adopt artificial intelligence and support domestic AI companies. The plan earmarks billions of dollars to increase adoption, commercialization, and sovereign compute capacity. Joining us now to share her thoughts on the plan is Joelle Pineau, Chief AI Officer at Cohere. Joelle, thank you very much for joining us today.
Hello.
What stands out from you from the announcement today?
Well, it's quite a broad announcement. There's many components, 6 different pillars. I think one of the things that really stands out is the focus on moving from a culture that really brought forward innovation in AI through the research programs and the talent pipeline towards bringing that to more of a commercialization side, developing industry, bringing AI into companies, as well as developing homegrown companies in Canada.
It seems ambitious. Does it seem achievable to you?
It seems ambitious, but I do think, we have a lot of the key elements in the country, whether it comes to having the energy to build our data centers, as I mentioned, having the talent on which to build our companies, having a very educated population. I think a lot of what's in that strategy is absolutely achievable with the right level of focus.
And where do you see Cohere fitting in with this? I mean, there's talk, there's the $500 million tech growth fund. They'll have they want a national champion AI firms and seed other companies. Where do you see Cohere fitting in?
Yeah, there's a few different elements. I think one of the things, where Cohere really stands out is our ability to build models. So that's recognized in there. That requires significant investment, both in terms of financial investments, but also the building of data centers. So really glad to see those measures in there. I do think for us, the investment that the government itself is going to make into transforming the public service is going to be important. It's going to be an important business for us in coming years.
And do you see any concerns if there is funding or companies that are funded by the government, their independence might be lost with this?
I mean, I think the Canadian government has a very sound process in terms of provisioning and so on. This is going to be competitive, as always, to do that. For Cohere, we also have a very healthy growth of demand on the commercial side in Canada, in the U.S., also abroad. And so I'm not worried at this time about this.
Okay, and one of the things you mentioned, data centers, and you're trying to position yourself as an alternative to the U.S. AI giants. Does the sovereign compute infrastructure change your competitive positioning, or does it benefit the hyperscalers?
It's certainly a very welcome measure in the sense of more availability of compute capacity is going to help us right now.
And I just want to go back. One of the things you mentioned was that we have the talent up here. One of the big issues has been trying to keep it. And also, I mean, if we do start growing AI, is there going to be enough talent to go around? Will you find yourself fighting for some of the best?
So far, there's a ton of young people who are incredibly talented, who are interested in this field. I have a bit of a foot in academia through McGill University, Mila. I was recently at University of Waterloo. There's a ton of, talented young people coming through that university system who are very keen to participate in terms of building those solutions, diffusing AI through industry and society. So right now, we're not seeing that as a bottleneck to our growth.
But we are seeing a lot of people heading south from those universities. Is this enough? Yeah. The idea of growing it, is it enough to keep them here, do you think?
I think what's hard is to convince folks to build new companies in Canada. There's a lot of talent, but when it comes to actually being first-time founders, this is where there's more difficulty in believing that you can start as well as grow in Canada. I think Cohere is a great example. We certainly hope to inspire many more to do the same.
What do you think would help assist that, to get more people to stay and build and become builders?
Some of that is just having that kind of community, having second, third time builders who really serve as mentors to set the blueprint for others. Some of that is investments. In particular, high-risk capital is much easier to obtain in the Bay Area than it is in Canada today. I do hope that some of the elements in the strategy will change that. There's been the launch of a venture fund at Mila, for example, that is paving the way towards some of that. But there's going to be a number of these ingredients that come together for that to become the norm rather than the exception.
And one of the plans for this is to grow jobs, create jobs. I mean, there's been a big concern about the impact of AI, people losing their jobs. We're hearing from CUPE, not happy about it, saying that the government is going after big tech and profits for big tech as opposed to people. Do you think what they have planned, this will help create jobs, or is CUPE not that far off?
There's certainly a number of measures here that should be a very positive signal in terms of creating jobs. One of that is the measures towards education in terms of up-leveling the education, even in the earlier phases of the training. Some of that is reskilling and retraining. So honestly, we'll have to see where I think, CUPE certainly has some interesting, experience is the fact that we will need to help the transition of a large amount of the workforce. The nature of the work itself is going to change, not just in big tech, but across several sectors. So I do think there's important work to be done there. I would hope that CUPE is a partner to be doing that work. The government has put a number of measures to help do that, especially when it comes to supporting SMEs through that transition. So I do think, we do have our work cut out for us in terms of carrying out the vision in practice.
And where do you see the jobs coming from for that, the new jobs being created?
A lot of the jobs that are being created in the short term is actually people who are able to understand the technology, understand a particular domain, whether it's financial sectors, whether it's healthcare, pharmacology, understand the ways in which AI can solve problems more efficiently in those domains. And so we have a number of solutions architects, forward deployed engineers, customer AI support teams who are crafting these AI solutions that solve real problems. In the short term, that's really where a lot of that growth is coming. Longer term, we'll have to see how quickly the change occurs.
Okay, Joelle, we have to wrap it up there, but thank you very much for joining us today.
Pleasure to be with you. Have a good day.
You too, Joelle Pineau, Chief AI Officer at Cohere. Coming up, industrial real estate is heating up in Canada's overlooked markets. Next, we talk to the CEO of ProREIT on the multi-million-dollar investment. Stay tuned. The federal government will provide funding to help AI companies scale up and plans to take equity stakes in Canada's most promising firms in its new AI strategy. Ottawa also aims to have 60% of Canadian businesses using AI tools by 2034 and says it will strengthen privacy laws and tackle surveillance pricing. The new strategy will focus on a range of sectors, including health, energy, manufacturing, and transportation. Prime Minister Mark Carney says the most crucial objective is to ensure AI works for Canadians.
Deep fakes, unsafe chatbots, AI-generated disinformation are becoming more prevalent. The privacy of Canadians is under threat. We are highly dependent on foreign suppliers for the infrastructure that powers AI, from compute to cloud to data storage. That creates real risks that foreign entities could access Canadian data, deploy AI products that shape Canadian lives without reflecting our values, and tilt the playing field against Canadian firms.
Shares of TransAlta are seeing a decline after the company announced it's buying 2 gas-fired power plants in Colorado. TransAlta says the $1 billion purchase from Blackstone will strengthen its foothold in the western U.S. The deal will also immediately add to free cash flow. Shares of Broadcom are taking a hit after the company delivered a disappointing forecast for sales of its artificial intelligence chips. Analysts are also noting that AI sales and margins for the current quarter came in weaker than expected. On the upside, Broadcom posted profit and revenue in its latest quarter that beat estimates. ProREIT just struck a massive deal for 17 industrial properties in Quebec City and Winnipeg, pushing its portfolio past $1.2 billion. What's driving this decision, and will it pay off? Let's find out with Gordon Lawler, President and Chief Executive Officer of Pro Real Estate Investment Trust. And Gordon, thanks very much for joining us today.
Thank you for having me.
Okay, I guess the question is, why Quebec City and Winnipeg? What made these so appealing to you?
Well, Winnipeg, we have approximately 1.3 million square feet of small and mid-bay industrial real estate there right now. So a large platform there that's performed quite well for us over the last number of years. And Quebec City, frankly, from our head office here in Montreal, is a natural step. We own real estate between Montreal and Quebec City all along the Trans-Canada Highway. And then I've actually been working and looking for almost 14 years to get a sizable portfolio in Quebec City. So very pleased with the outcome and the announcements yesterday.
So 14 years, has it just been, there's never been the right opportunity? Is the market right for you now? What changed for this?
It was previously controlled by a larger REIT called Cominar REIT out of Quebec City for as long as I've been around in the real estate business, and then changed hands to some institutions in the past 5 years. So now there's an opportunity to purchase some of that real estate. So we took that opportunity.
And what are the positives do you see with this deal? For Quebec City, and then we'll talk about Winnipeg. But what does that give you? A nice corridor? Is that it continues that corridor in Quebec?
Yeah, so our largest piece of portfolios, we control. We have 3 million square feet with our JV partner Crestpoint out of Toronto, with 3 million square feet in Burnside Industrial Park in Halifax. Then assets on and off the island of Montreal. So a natural fit is Quebec City in between. Like Halifax, it's a large port. It's a capital city. It's got a lot of defense spending to come. And government, and it often operates separate from Montreal. So it's a million people, and great place for a good secondary market for our kind of real estate.
And Winnipeg, the reasons for that?
Same thing, 1 million people, good transshipment hub to the West Coast. Not all the big players are there. From a real estate standpoint, so we've managed to accumulate 1.3 million square feet there, and very pleased with the incremental cash flows we're getting and the increased rents we're getting since we purchased.
And it's a decent sized layout. It's more than 10% of your portfolio, and now that you've grown the portfolio up to that point. Where's the funding coming for this? How will it be paid for?
So yesterday we just announced a $72.5 million bought deal to the public. That was oversubscribed, to my understanding, as of this morning. And coincident with that, we had a $16.7 million concurrent private placement with Collingwood Investments, which is the Bragg group of companies out of Oxford, Nova Scotia. And they've been around us and invested in us since early 2021. And Parkit, as another 10% investor, came in for 10% of the REIT back in June of 2025. So over $100 million when you put it all together, and a great deal in a complicated market and a complicated time.
Now, are you almost pure industrial now? Is that the goal?
Yes, we've been transitioning over the last 3 years. We had a good portion of Sobeys anchored, grocery anchored pharmacies and strips as well, but we've sold them off to really focus on small and mid bay. And we're over 93% of our cash flow comes from small and mid bay industrial real estate right now. And
is the goal that other 7% to move that as well?
Eventually, but no real hurry on that. Our goal was to get to the 90% mark, which we achieved in 2025. So we don't have a need to sell the other properties. They're good cash flowing properties. But if the opportunity comes upon us, we'll look at that as well.
Nothing's for sale unless it's a good price, right?
That's right, especially in the real estate business.
Why the small and mid? What's so appealing to you for them?
So small bay real estate, it's 50 to 150,000 square feet properties. The mid bays, more 100 to 250,000 square feet. There's not a lot of that being rebuilt across Canada. The cost per square foot to build it is higher than the rents you achieve. And so we're our own owner manager with our wholly owned property management group Compass out of Dartmouth, Nova Scotia. So we have, with a roll up your sleeves, manage the real estate ourselves type versus a fund that would have, third party management and that type of thing. So you have to really have the roll up your sleeves piece for the small and the mid bay. And we've succeeded with that.
And are there any near-term releasing risks right now?
No, I mean, we're not 96% occupied across the portfolio. We do get some spaces back by times. Tenants always have needs for more or less space depending on their business needs. But in general, across Canada, industrial real estate's been quite strong. The weakest part of it is kind of GTA large bay, where it is, you do have the ability to build that kind of real estate, 500 to 1 million square feet, and be able to achieve market rents. But it's the smaller assets that's quite the challenge. And we're secondary market people. We're not in GTA or those areas. So we've done very well with this with this strategy.
And you see more opportunities over the next little while?
Yes, for sure. I mean, real estate, industrial real estate's been quiet the last 2 or 3 years. We're starting to see some deals here. I mean, with the conditional deal that we have, it's $159 million of real estate here. So that's a good chunk from 3 different vendors. So, we see opportunities. It's just there's always a delta between the price you want to buy at and the price the vendor wants to sell at. So that's the challenge all the time.
All right, we have to wrap it up there. But Gordon, thank you very much for joining us.
Thanks so much for having me. Have a great day.
You too. Gordon Lawler, President and Chief Executive Officer of Pro Real Estate Investment Trust. When we come back, shares of CrowdStrike dipped today despite reporting a strong first quarter. We'll look at what's driving the movement. Shares of CrowdStrike dipped today despite reporting an earnings beat in its first quarter. The cybersecurity company topped its revenue estimates but saw little growth in its annual recurring revenue. Here for more perspective is Todd Weller, Managing Director of Technology at Stephens. Todd, thanks very much for joining us.
Thanks, Roger. Good to be here.
What bothered people the most today with this report?
Yeah, so look, I think results overall were solid. ARR growth of 24% accelerated from last quarter. I think it just comes down to the lack of upside relative to guidance and consensus in the quarter. The ARR beat was 0.1%. We've seen some bigger beats in the past. And, when you have a stock that is up, 97% since April 10th and over 50% year to date, expectations were a bit higher. So I think it's just some short term kind of disappointment with the lack of upside relative to any big concerns on the fundamental front.
Yeah, was that no matter what they did, they wouldn't satisfy people?
These are always tricky situations, right? It's funny because when we were doing our preview, right, heading into March quarter results, sentiment was markedly different for cybersecurity and broader software was really negative, and that really changed significantly. So April quarter companies, I think, had a much different setup, a much higher expectation bar, and that's really what you see with CrowdStrike, and you saw it with Palo Alto Networks as well earlier this week.
Yeah, I'm just looking at the net new ARR was a record. 256 million, yet still not enough, right?
Yep, and that's what you get with high expectations and when you have high valuations on stock. So again, we tend to look more at the long term. We appreciate near term setup and trading around quarters, but the question we look at is what does CrowdStrike's growth profile look like? Does the fundamental story still hold? And I think 24% ARR growth was very strong. The other thing I would keep in mind is there is seasonality to all software businesses. This was their first fiscal quarter. It's typically a seasonally weaker quarter, and then seasonality builds throughout the year, with the fourth quarter being the strongest typically for software companies.
And is there any concerns about the SaaSpocalypse with CrowdStrike at all, or is that backed off from a lot of them?
That's backed off for CrowdStrike and broadly across cyber. If you go back to earlier this year, you had the announcement of Claude code scanning, code security, which drove the first wave of concern. Then Mythos really kind of accelerated that. And there was a couple of month period where it was really rough sledding and extremely negative sentiment for cyber. And that narrative really started to shift when with Project Glasswing, which was Anthropic, where they started to partner with the cybersecurity companies. And investors got more comfortable. And so you've seen a big narrative shift towards, cyber now being increasingly viewed as an AI beneficiary versus being disrupted by AI companies.
So what does CrowdStrike have to do then to kind of ease some of these fears that we saw today?
Yeah, so look, I think it's just continued execution with CrowdStrike. We're talking about 24% growth on a big number, right? So this is at scale growth, over $5 billion of ARR. So that's impressive type growth. Obviously, we think putting up some upside to estimates would be good, and we think you can see that over the course of the year. There's a lot of good growth angles to the CrowdStrike story. AI is emerging as a bigger tailwind across its business, whether it's endpoint security, their security operations products, identity security. And then AI is creating a whole new opportunity to specifically secure kind of employee use of AI applications and models, and coming down the pike will be securing AI agents. So I think for CrowdStrike, it's sustaining strong growth and starting to see kind of AI have a bigger impact on the business as well.
Is that what people were looking, that they thought AI, because we'd heard that talked about a little bit, were they expecting more from cybersecurity with AI than they got?
Yeah, potentially. It's a little bit of a complex topic because you have AI, I would argue, has been a key influencer of CrowdStrike's demand that we've seen over the last several quarters. It's driving a lot of modernization activity. For example, companies have identity security platforms that they've had for many, many years, but trends like cloud and now AI is driving customers to say, we have to upgrade these to more modern platforms to be able to handle that. And so we're seeing this dynamic across the cyberspace that I think is a bit underappreciated. So one dimension is AI is influencing demand today, and we see that in CrowdStrike's growth. But then the second dynamic is there's newer AI-specific opportunities. And to one point to what you brought up as well is, look, I do think with Mythos and the increasing awareness, there's a view that that's going to drive increased cyber spending. And we think that's true. But that's also not something that materializes overnight. There is the reality of budgets being set and customers having to procure and deploy solutions.
All right, Todd, we got to wrap it up there, but thanks very much for joining us.
Thank you.
Todd Weller, Managing Director of Technology at Stephens. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Joining us now for some movers south of the border is Bloomberg Equities reporter Matthew Griffin. Matthew, thank you as always for joining us. Let's get right to it. PVH being left on the change room floor with the Iran war having an impact.
Yes, well, Roger, this is something you've heard from me before with regard to other companies, but the owner of Calvin Klein and Tommy Hilfiger, just the latest company being punished by investors for its exposure to the war. And like you said, not having a great day. In fact, heading for the worst day since 1987. Last time I checked, they called out several areas where the war is hurting results in their Europe and the Middle East segment. So you have the fact that consumers just aren't buying clothes in the conflict region. But then even beyond that, tourists are not traveling to Turkey in particular. That's another blow. And at the same time, consumers across that broader region, again, Europe and the Middle East, aren't spending because of higher gas prices. They just have less disposable income. Now, the company actually left guidance unchanged for the full year. They still see adjusted earnings per share of $11.80 to $12.10 US, but that was helped by this one-time benefit from tariff refunds. Analysts weren't especially impressed by that, and it seems like investors in this company weren't either.
All right, going the other way, though, is RTX.
Yes, got lots of three-letter company names today.
We do.
RTX shares. RTX shares rising about 3% last time I looked after an upgrade to buy at Jefferies, the aerospace and defense company. Jefferies expects them to benefit from across their aerospace, commercial aerospace and defense businesses from assorted tailwinds. So you've got pricing power in their Pratt & Whitney commercial aerospace business. You've got the sale of aftermarket parts and services for its engines after they're installed. And then you've got expected double-digit growth for items like sensors to countries' militaries, not just the U.S., but other parts of the world. And that's a real vote of confidence for a company like this right now. Defense stocks really rallied at the beginning of the year during all of the geopolitical turmoil that took place. But during the Iran war, that trade actually hasn't worked. RTX is now in the red on the year, down about 2.5%. This upgrade from Jefferies, though, helping them close some of that gap today.
Okay, I want to get to this last one. INEO, they're just first day trading. They're a gas-fueled reciprocating engines company.
Yes, so that's a bit of a mouthful, but what you really need to know is that they sell those engines to data centers. This is the latest U.S. industrial company to go public, sort of riding the artificial intelligence boom. And I should say, listed in the U.S., this company is actually based in Munich. They make these engines under the Jenbacher and Waukesha brands. They are for power generation, so that's a hot commodity for data centers right now. They want all of the power they can get. This company shares trading around $33, went public at $27 a share after raising more than $2.4 billion. Their major shareholders are PE firm Advent and the Abu Dhabi Investment Authority. Those shareholders were the ones who raised the money in this sale, and are going to maintain majority control of the company going forward.
Sounds like timing is everything on this. Good timing. It's taking SpaceX's thunder.
Yes, so the AI trade just keeps going. You had companies like Forgent, Madison Air, these other big industrial companies go public. Both of those have had blistering runs this year, also on their connection to AI. And right now, it just seems like investors' hype here has no bounds.
All right, we got to wrap it up there, Matt, but thanks as always for joining us.
Thanks for having me, Roger.
Bloomberg's Matthew Griffin. Well, the leader of the official opposition of Canada, Pierre Poilievre, will join the BNN Bloomberg program today to discuss Canada's new AI strategy. That's at 4:30 p.m., as well as the economy and upcoming CUSMA negotiations. You can catch them on the close, again, at 4:30 p.m. Eastern. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thanks very much for joining us. Have yourself a great afternoon.